My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Edwin Dorsey of the Bear Cave newsletter. I'm a little jealous of the name Bear Cave. I prefer Risk On, Risk Off Cave, but that cave has been brutal this year. Edwin, for those who are not familiar with your background, introduce yourself. Who are you? How did you get interested and involved in markets? What are some of your specialties? And why a bear cave?
Michael, absolutely. And thanks again for having me on. So, I've been passionate about stocks from a really young age. Like second grade, I was all about the stock market. In high school, I began writing about stocks anonymously on Seeking Alpha. And my transition to the short side really happened freshman year of college when I was lucky enough to be introduced to two of the greatest short sellers. One was Mark Cahodes, who lives in Northern California and used to run a short only fund. He kind of showed me the ropes of short selling, showed me how to research companies, convinced me to get on Twitter and have a little bit of a Twitter presence. My other early mentor on the short side was Jim Carruthers, who ran a short only fund called Sophos. And I interned there on and off all 4 years of college, and that provided a lot of like educational experience on how to research companies, intros to a lot of the people in the short world, how to do FOIA requests, deep research, stuff like that. In college, the thing that got me a little bit of attention is I got in a big fight with a publicly traded company called Care.com. That was a large babysitting platform, and I showed that they weren't doing the safety checks they claimed to be doing, and that got a lot of attention. And I kind of parlayed that when I was graduating in the pandemic in March 2020. Rather than going to work at a fund in New York City, I decided to start this newsletter called The Bear Cave, which is focused on exposing corporate misconduct. And frankly, I thought if I started this newsletter and showed I was smart and, convinced people that I could be useful, it would help me land an even better job right out of college. But the newsletter in its own right became really popular. In September 2020, I turned on the paywall for it, and it just kind of took off. And that's been my only job since graduating college. I've been doing this for 2 years, and the newsletter is focused on exposing corporate misconduct. And I like to say, I'm writing about companies that are either misleading investors or harming customers. And that's basically how I spend all my time researching, the corporate shenanigans of the world.
How does personality fit into being somebody who's focused on the short side, focused on, exactly what you said, kind of the fraud or misleading side of things, right? Because most people, they just want to go about their days. They don't want to ruffle any feathers. They want to invest for the long run. I feel like it takes a certain type of personality to do what you do.
Absolutely. Mark Cahodes, who's on Twitter at Alderlane Eggs and is a great person to follow, he says short sellers have a genetic defect because no one healthy would want to do this. It's much better to go along to get along, earn a lot of money, and not ruffle too many feathers. I don't know what exactly prompted me to get into the short world. I think it was just that a lot of my great early mentors were on the short side. I joke if I met two great microcap investors my freshman year of college, I'd probably be here talking about microcaps. If I had two great private equity mentors, early on, I might be going into private equity. But it just so happened that I got introduced to two really great short sellers early on. The thing that's also really unique about short selling that isn't true in any other parts of the market is I feel like in short selling, you can really make a difference for the better. A lot of finance, if you're buying and selling stocks, it's a little bit like just trading pieces of paper back and forth. But activist short selling in particular, it can have the same effect as journalism in some ways, where if you go, you shine a light on misconduct, you publish a report or two, you really just like explain, how a company is hurting society. Regulators do notice that, the market notices that, and if you cause a fraud to collapse, you've done a real good for the world. And at least a lot of the big short people I talk to, there's a special satisfaction that comes from doing deep research, looking into stuff, and knowing that it makes an impact in the long run, whether that's publishing it yourself, whether it's giving it to a journalist, or whether it's just like playing out as you saw it and like alerted others to it. You can actually like have a little bit of an impact in the short world.
Let's talk about the name of the space. We were going back and forth, and you said, naming it the golden age of fraud is probably appropriate. I have my own theories as to why it is a golden age of fraud, and I'd argue it's related to technology and manipulation of emotions. But let's talk about all the fraud that we've seen, and there's a lot of it, not just kind of post-COVID, but even before that, I think investors are under the impression that just because there's regulation, there's fraud, or just because something's on the blockchain, there's no fraud, or just because something's on the blockchain, there's no fraud. Why is it that it seems like we're hearing more stories of fraudulent businesses and activity than before, or am I just crazy that this is just kind of it's been louder than I myself am used to?
So the term comes from Jim Chanos, who's kind of coined the golden age of fraud to describe a lot of the recent market stuff. I don't know exactly why it feels like there's a ton more of the nonsense going on in the world. A lot of it has to do with free flowing money. When money's flowing really easily, when you have a lot of people investing in SPACs, when you have a lot of retail participation that's earning easy money, that begets more retail participation. And that I think is where you get a lot of the most egregious conduct is at least like I'm more focused on publicly traded companies than blockchain stuff, but a lot of the most egregious things are just companies that cater purely to retail investors. And when you see a lot of retail excitement and participation in the market, that's when you start to see the most egregious stuff come out. Sometimes say these are like companies that lack economic substance. So kind of one example that comes to mind was there was this company, Ag Eagle Aerial Systems, ticker UAVS, and they reached like $1 billion market cap, saying they were going to remake a next generation drone. They hinted at a partnership with Amazon, but really like their entire like product was, just like a remote control helicopter with a GoPro taped to it. They never had any real substantive revenue. Their total R&D over 5 years was like $400,000. It was just like a company that lacked any economic substance. But the way it was able to get so big is it partnered with, a group that had a history of promoting penny stocks. It started making like cryptic Reddit threads, weird YouTube videos, nonsense press releases. And in a bear market, none of that will like, buy you attention. But in a bull market with a lot of retail investor participation, can make the stock go up 1,000%, which is what happened. And of course, it ultimately collapsed. But to answer your question, why are we seeing so much fraud or stuff come out? I would say it's linked to the fact that we had a huge amount of retail participation that may have not been super sophisticated, just throwing money at anything based on really little due diligence. And, just like good behavior is contagious, bad behavior is contagious too. So when you see other people cutting corners, whether you're an investor, whether you're a venture capitalist, or, an executive, you tend to cut corners as well. I think those are all factors.
Yeah, and I also think it just going back to kind of the point about technology. I mean, there was a lot of fraud that was enabled in the latter stages of 2020, early stages of 2021, as, for example, Clubhouse got more popular, and people were having rooms talking about cryptocurrencies, and anonymous accounts sounding like they were actually big deals were essentially kind of manipulating human emotion with words, right? And with what they were saying. I've even made that argument before that it was pretty easy to push a shitcoin higher and have a fraudulent project. All you need to do is have a bunch of bots on Twitter that were basically saying this thing's gonna go to the moon, and you had enough people seeing those bots thinking they're actually human beings that it kind of becomes a self-fulfilling prophecy until that which pumpeth dumpeth, as I used to say. So I say all that because I don't know if this is going to really get better. The regulators seem to be slow to respond. You can argue that a lot of the laws are in place to prevent fraud; they're just not really being enforced. And it's very clear, even despite all the Fed's actions, that there's still a ton of stupid money out there that maybe enables this kind of behavior.
Yeah, I'd agree with that. I think the way to think about regulators, or at least as I've like, gotten into this more, I think the right way to view regulators is as like financial archaeologists. And this is also like a term from Jim Chanos is they're very good at figuring out what happened after the fact. They go in, they collect a lot of documents, they issue subpoenas, they interview people, and they can create a compelling narrative of what went wrong after the fact, what crimes were committed, and who should be held accountable. That's kind of like how you view regulators. I don't there's a sum of this proactive stuff, but very rarely does a regulator say, oh, this company that has like, a high market cap is a fraud. Let's go in, dive in, and shut the whole thing down. By and large, regulators today, like the SEC, at least financial regulators, are disclosure agencies. They really care about full, accurate, and complete disclosures and pushing for that. And as long as something is disclosed, even if it makes no sense, even if it's a nonsensical footnote, even if it like is not necessarily helping, shareholders, as long as it's disclosed, it's kind of acceptable. So that's how I view regulators: is disclosure agencies pushing for more disclosure, and like financial archaeologists who are good at figuring out what went wrong after the fact. And this has been like the case forever, where like, every fraud that's collapsed has had audited financial statements, or the vast majority of the ones in the public markets. So it's kind of wishful thinking to say that regulators are going to be like preventing all this stuff. What I will say, I guess, to give a little bit of credit to regulators, is it's a very tough job. And the US has the best capital markets in the world. And you probably can't have the best capital markets in the world if you don't have at least good regulators. So, as much as people like to criticize the SEC and FINRA and whoever, I don't have as negative of a view. And if you want to know why, just go look into like Germany, where their financial regulator was like investigating the Wirecard short sellers and whistleblowers and like actively helping a fraud succeed or go on for a long time. So, yeah, it's easy to kind of criticize regulators, but I think people are just viewing them wrong. And the correct way to view it is, disclosure agencies and financial archaeologists, rather than like their jobs to prevent fraud.
Yeah, I'll tell you what, it's interesting because I don't disagree, right? But at the same time, it's interesting, right? So over time, you've had more disclosures, more requirements for disclosures, but you've gotten to a point now where there's so many disclosures and the attention spans are so short that it almost doesn't matter for the end investor or end trader, because they're not actually reading the disclosures because it's too long, didn't read, right? So perversely, I'd argue that the push for having every single thing disclosed actually means people are paying less attention.
That might be very true. My takeaway might be a little different. My takeaway would be you should read the disclosures, and
Oh, 100%.
there's a lot of value in
Exactly.
reading these. And that's what I'm spending a ton of time doing. Like for the Bear Cave, I spend a ton of time reading SEC filings, seeing which disclosures change. And I think everybody seems to have this view. Oh, everybody else reads the 10Ks and Qs. It's all priced in, so it doesn't matter. So I'm not going to read it, or it's too long, or whatever. And that's very dangerous. So I love reading like 10Ks and Qs and looking through all the weird stuff. And you're right that some disclosures are antiquated. Like the fact every public company needs to have a section for mine safety disclosures probably doesn't make sense, right? But I think it's great. And if anything, I'd want more, because often the goodies are in the footnotes or buried 80 pages deep. And once you get good at navigating this, you kind of know where to look. So like now I think every investor at bare minimum should look at the related party transactions section, because, one company I wrote about recently, Michael, that we might talk about is Silvergate Bank, a bank that catered a lot to the crypto space. And there in the related party transactions section of its proxy statement, they disclosed that like the bank's chief risk officer was the CEO's son-in-law, and the bank's chief of correspondent banking was a different son-in-law, and their chief technology officer was the CEO's son. And when you see like a lot of stuff like that, to me, it's usually a red flag or something intriguing. The other thing, disclosure wise, that I don't think enough people look at are SEC comment letters, which are informal correspondence between the SEC and a publicly traded company. A lot of individual investors don't even know that exists. Like sophisticated ones might not look at it. I think you can often find really interesting or useful information there, especially for like US listed Chinese companies and SPACs. So I agree. There's tons of disclosures. There's a lot of noise, and a lot of people don't read them. And my takeaway would be you definitely want to spend a lot of time looking at public company disclosures, reading it. And once you do, you kind of like develop a spidey sense in like what's abnormal, what's good to dig deeper. One account that's like good at this is Footnoted on Twitter. They're probably a good follow. I also use like a software tool called Bedrock AI, which is kind of new. They scan all SEC filings and like highlight interesting disclosures. And I kind of like them. But just reading disclosures, I highly recommend it, even if it's like a little boring.
No, look, I agree with you. I'm just, unfortunately, as you know, right, it's like sometimes you have to kind of go to the lowest common denominator of understanding and of attention span, unfortunately, right? I myself am just very cynical of the trend of system one reacting. I mean, the reality is most people's due diligence is looking at a chart. It's not really looking at anything deeper, and that's unfortunate. But we'll play with that a little bit more. Somebody else who's also very good at doing research is.
Thanks for the high praise, and I'm glad your interns are reading it too. I'm addicted to Twitter. I think Twitter is just an outstanding way to like come up with information. And in the finance world, there almost seems to be like this maybe arrogance in some way where people like it if their idea comes from a fancy model or like a fancy expert network call. And it's like almost embarrassing if you say, oh, I read a tweet and that's where I got something. So but I think if you know where to look and you spend a lot of time curating a good Twitter feed, you can come up with a lot of good ideas. To track activist short sellers, I just create lists of all the activist short people, and that's how I track stuff. I have like 10 different bookmark folders where I'm bookmarking various things throughout the week. And, I probably spend more time than most on it just so I can like deliver a good newsletter. But Twitter is kind of like key. And I do spend some time reading Value Investors Club, skimming Seeking Alpha, but Twitter is my favorite way to like keep in line with all these other investors. I think if you like just if you seek to get ideas, you'll get some. But if you just seek to add value and be useful and help people, you'll like learn a ton, and everybody will be like flagging stuff for you. So I've also found just trying to be a useful participant and not necessarily like having an angle to try to get something all the time. I think that generates a lot of goodwill and people can feel it, and they're likely to tag you in interesting tweets so you see it and like DM you and help. So, in terms of like, actually writing the report and doing deep dives in the bear cave and like, especially the stuff for paid subscribers, like I write 100% of it myself. I tend to be very document based where I try to pull as much as I can from documents like litigation, SEC comment letters, filing, stuff like that. In terms of coming up with ideas, how do I originate ideas? I would say that is a little more, fluid where Twitter's again the really big one. People like tagging me in tweets or DMing me over Twitter to just to get me interested in something. That's how it could happen. Like one of my popular articles over the past year was on Roblox's child safety issues. And the way I heard about that is I think someone tagged me in a tweet that a YouTuber sent about like a young YouTuber who was being sued by Roblox. And it just like kind of piqued my interest. And that's how I started looking into it. Some people, my emails in my profile, people can email me, and like occasionally I'll get a tip over email or somebody I know will just call. So I'd say in terms of like originating ideas, it's just everywhere with Twitter being the main thing. In terms of doing work, the stuff you read in the bear cave is all my writing and, all my work. And in terms of screening, I kind of want to get better at it, but it's usually, I wouldn't say like I run normal screens. I'm addicted to the SEC full text search, which lets you like search all SEC filings for specific terms. So my screen wouldn't be like price to book or price to earnings or something like that. My screen would be like, hey, let me see all the people that use this audit partner, or let me see like every company that has this specific sentence of disclosure, or if I'm bored, like every company that employs the CEO's son in some related party capacity. Like that's the type of thing that I'm looking for to come up with ideas. The last thing I'll say that I do to come up with ideas, and this is going to sound a little weird, is like I just track board members. If I'm bored at night, what I'll do is I'll look for a SPAC or IPO that's like collapsed, fallen 90%. And I'll go and I'll just see, okay, who are all the board members and what other boards do they serve on? Because if your first company collapsed 90%, I want to bet against your second company because that might collapse. And, it's just kind of like, so a skeptic might say, oh, why do you care? Board members don't matter, blah, 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 blah. They're not influencing the value. Fine, I get that. But in my view, winners win and losers lose in the public markets, at least. So find somebody who has a track record of losing and bet against them, or at least do the research on the companies they're associated with. To me, these aren't fancy ways to come up with the ideas. These aren't sophisticated ways to come up with ideas, but I think they're effective ways to come up with ideas, and that's what I look for.
Yeah, everybody, please make sure you follow Edwin Dorsey here on Twitter and check out respective research. Yeah, that's the first time I've heard of somebody being bored, and the response to being bored is to look at board members. That's a new one, for sure.
Yeah, so thanks for the question. And I've actually written about Coinbase in the Bear Cave in the past. So I'll try to DM you that after. And it's just online with the Bear Cave. But at a high level, I would say I'm very skeptical of Coinbase. Fraud is an extreme word to kind of use. So I wouldn't use the word maybe fraud to describe Coinbase. But let me give you kind of my high level view of Coinbase and why I think, investing in the stock is like a little problematic, and why I'm not a big fan of the company. So at a high level with the crypto trading, we have main coins like Bitcoin and Ethereum. And despite being really critical on the crypto world, I actually see value in Bitcoin, and I kind of get it. But so you have Bitcoins like that, and then you have a really long tail of hundreds and hundreds of kind of nonsense coin like sushi coin or pancake coin or fraud coin or whatever you want to call it, like this long tail of like kind of just weird projects.
Do not badmouth sushi. I love sushi. Sorry.
So absolutely, Michael. So we got this long tail of coins, and Coinbase has historically made a lot of money being the best place to trade this long tail of coins. Anybody can make a Robinhood and trade Bitcoin and Ethereum for like very low cost. It's just this long tail of coins that you can't trade on Robinhood that's like more difficult to access. And that's what Coinbase has historically made a lot of its money and volume on. And that's also like where I don't, again, fraud might be like an aggressive term, but that's where a lot of the nonsense occurs. And that's where a lot of like, crypto, the sentiment's really changed. And the sentiment to buy pancake coin or whatever is probably like near zero. And I think it'll remain that way for a very, very, very long time. So you're going to see this like previously like one time hugely profitable thing go away. And then now like the ability to like buy and sell big coins like Bitcoin is kind of like a commodity. I think Fidelity is going to try to roll it out. Robinhood, Webull. There's like a lot of places you can do it. And a lot of places are going to be using crypto trading for the Bitcoins as kind of a loss leader to generate customers. So if SoFi can offer crypto trading at a loss or like very slim margins just to get people onto their platform and then cross sell other products like stock trading or US dollar deposits or banking products or student loans or whatever, and so you're going to Coinbase, which only does crypto trading, is competing against everybody else who's going to use crypto trading as a loss leader to attract young people to their platform. So that makes it like even more of a headwinds for the company. And despite all these increasing headwinds, they're losing gobs of money. So if you're losing like $1 billion a quarter or $500 million a quarter and things are getting worse, then you're going to be losing even more money going forward. I'm really not a fan of the leadership. I think Brian Armstrong just like isn't like prime time ready. And you just see that, and he's kind of antagonized. When you run a large public company, you have a lot of different constituencies. You have regulators, you have shareholders, you have your employees, and he kind of seems to have antagonized everybody. And maybe there's like some weird like contingent of Silicon Valley who's like, yeah, he stands up for free speech or something. But I think by and large, like he's pissed a lot of people off. A lot of people describe working at Coinbase as like kind of a mess. Employees are leaving in droves. It's one of these companies that like is a little bit of a self-fulfilling prophecy where when the stock's down, it's tough to attract and retain your best employees, so they leave, compounding the problem. So, all that combined, you also have like litigation risk, I think, related to selling some of these coins that are allowing users to buy these coins that went on to collapse. So I just don't see much value in like Coinbase. Yeah, you have a brand and you've got a lot of accounts, but it's not profitable. The headwinds are getting worse. I don't know if it's like really useful for society. And even if you believe there's some value in crypto or Bitcoin, like I do, that doesn't mean Coinbase is like worth a ton. It's just one of many places you can go to buy cryptocurrency. So there might be like some first level thinking, oh, FTX collapsed. That's good for Coinbase because they'll get a lot of new users. But I think the harms way outweigh the goods. I am skeptical of USDC and how it impacts the banking system. I don't know if there's like a huge Coinbase risk there, but as the contagion spreads, like if people can't redeem their US dollars, USDC, like I could definitely see Coinbase get wrapped up in more litigation or something. But that's just my speculation. Anyways, to sum it up, I'm hugely bearish on Coinbase. Definitely not my cup of tea.
Can I ask, and just as maybe an offshoot of that, because I think it's interesting because you alluded to it a bit earlier. I gotta imagine there's maybe a fine line, or maybe it's not too fine of a line between mismanagement and fraud, right? I mean, you can have a company that's mismanaged, but not necessarily have the management team outright commit fraud, but it might look like that unless you're doing some real deep dives. How do you make that distinction?
So I'm always hesitant to use the word fraud. I really don't like using it because I think it has like a legal meaning, and I don't know. So it's tough to like generally the way you might say fraud is like actions taken with the intent to deceive. So like an example of something that's not fraud would be like Bob Chapek at Disney. Incompetent, maybe. Pissing a lot of people off, maybe. Like having a big harm on society, yeah. But like fraud, no. So fraud would be more, again, and I really don't like using the term to describe like people or specific companies because it can be a little like inflammatory, but just actions taken with the intent to deceive. So channel stuffing might be an example where in order to move product and hit your numbers for the quarter, you give discounts a little just at the very last day of the quarter to move some product and make that quarter's numbers. Then of course, it's going to be more difficult to make next quarter's numbers because you've just pulled forward some sales. So you need to do more channel stuffing. And then you need to do more channel stuffing in the quarter after that. Then sooner or later, like you're about to miss numbers huge. And like, you might do what Luckin Coffee did and like sell gift cards to like the chairman's secret company and record revenue that way, like just in like frivolous $10 million gift card increments to like a related party or stuff like that. That to me is like more fraudy. Or if you have a company that's public that does a lot of business with a related party that is owned by like the controlling family or the CEO's family, that could be like rife with like potential fraud where you either use the public company to like loot, you either use like the private company to loot the public company, or vice versa. You might use a private entity to help inflate the numbers at a public company so you can sell stock at elevated valuations. That's the type of stuff that like kind of comes to mind with fraud. Mismanagement, it just kind of appears in the numbers, and I think a lot of times can be related where if there's some mismanagement or things are going poorly, the way you try to cover it up is just a little bit of channel stuffing or fudging the numbers just a little, which is why I think the SEC like a month ago or 2 months ago said, as we're going into a recession potentially, auditors should be even more vigilant for signs of fraud. Because every CEO and CFO wants to keep their job. And the way you keep your job is delivering good numbers. And when times are tough, that can be tougher, and you might turn just to being a little more aggressive. And I don't think people fully realize like the amount of wiggle room public companies have. And this isn't my area of expertise, but there's often like accounting reserves big companies will have, and you can just like change one calculation on that reserve a little to make the reserve go down by 20 million, like let's say a litigation reserve or like a pension liability or something, or tweak it again to make it go up. So like that's the type of stuff that I think of like when I think of fraud. And then mismanagement, it's like kind of appearing in the numbers, and just that things aren't going well, if that makes sense.
Yeah, no, for sure. Let's go to
on stable coins. Again, I'm not a super expert here, but I might, at least my instinct would be to disagree, at least on the economic prospects. It seems like issuing a stable coin is actually a wonderful, wonderful business where if people are on crypto exchanges, you don't want to have just like US dollars you need to convert. into different coins. You want like a cryptocurrency that is easy to trade for coins, and like crypto like platforms just want to deal in like coins. They don't want to handle like US dollars. So I kind of get that, the need for stable coins from a user perspective. And then I get why issuing them could be so profitable, because it's kind of like free deposits, where if you're a stable coin like USDC or Tether, you have tens of billions of deposits from millions of different users who are like essentially just like giving you this float of deposits. Now, there's inflows and outflows every day, but you have like, a $30 billion pool of money that you can invest in treasuries that earn 3%. And you're not rebating any of that to the users. You're keeping that for yourself. So if you have like a $30 billion pool of deposits and you're investing them in like short-term treasuries at 1% or something, that's $300 million a year from you. That's great. And of course, like the inclination is, well, I'm earning a lot investing in short-term treasuries. Why don't I move to longer-term treasuries and get a little bit higher of a yield, so I get more money for myself? Why don't I go to some commercial paper where I get a little more money? Why don't I go to Chinese paper where I can get a little more money investing my like, float from all stable coin issuance? And then it kind of just becomes like you get greedier and greedier and hoping for more yield. And that kind of seems to be what like happened with Tether. And then if you invest all this money that's supposed to be backed one to one into like really risky instruments that are high yielding but might go down, then you won't be able to meet all redemptions. You can probably meet a lot, but you can't meet all of them. So that's kind of my basic read on the stablecoin world. So I can see why it can be like hugely profitable. If you're like USDC, you get billions in deposits and you invest them in treasuries, or at least you claim to. But I just the utility of all this crypto space is sometimes lost on me. I get Bitcoin, but just the desire to trade, like even Ethereum and all the other ones, I at least personally don't get it.
Can I just say real quick? I'm glad you asked that question, because right now my vision of Edwin is, he's in a bar like in It's a Wonderful Life, okay, because of his profile picture, and he's drinking, looking at due diligence documents, and trying to figure out who at the bar knows a board member because he's bored. Sorry, Edwin, go ahead.
Well, thanks, Michael, and thanks for your longtime support of the Bear Cave. I appreciate every subscriber, so I really appreciate that. What keeps me upbeat? I would say I'm a really naturally upbeat and happy person. I think sometimes you just got to realize that fighting large institutions is a very, very difficult thing, whether it's a company, a regulator, or a government. And you just look at the history of like all these whistleblowers who like spend years going against the companies. A lot of them like commit suicide or get into drug use, or their life falls apart. It's really brutal. So I try to like keep that in mind, and at least my approach has been a little different, where instead of waging a years long campaign against a company and saying, come hell or high water, I'm going to expose this misconduct, I'm going to hold these guys accountable, I take at least a lot more of a lighter touch, where I'm basically writing on a new company every 2 weeks or twice a month for the paid portion of the Bear Cave. And when you do that, you can get a point across. You can, show your views, show what you found, shine a light on misconduct. And sometimes the media will run with it and it'll have a big impact. And a lot of times the impact is more muted. And that's kind of okay, because at least then you're not like, getting in years long fights with companies, and you live to fight another day, and you can keep shining a light on misconduct. What's tough, and what I admire about Mark Cahota, is he does the opposite. He says, I'm going to fight when I find a fraud, I'm going to spend years and years of my life to expose it, which is great for him, but and very impactful. It's just like that literally takes years off your life. You're going to have so much stress. You spend millions of dollars a year on lawyers. So that hasn't been my approach. The thing that can keep me optimistic, keep me high energy, and give me almost a love for this exposing the corporate misconduct is the fact that I'm moving on to something new, rather than like getting in long-standing fights with companies. And if you punch at a company enough, they will fight back. They could hire a private investigator, they could sue you, they could try to dig up dirt on you, they could try to convince a regulator to look at you and not them. Like that stuff happens. So just kind of taking, a more like neutral toned approach to this, not being sensationalistic, all that kind of makes it more sustainable. And I would say the other thing that makes me happy is the fact people like you and thousands of people like you subscribe to the newsletter. The Bear Cave right now has over 35,000 free readers, over 1,000 paying readers. It's like kind of truly remarkable. And seeing that level of support, it's really heartwarming. So that's what keeps me super happy and makes me excited to do this every day. Absolutely. And that's a great question. I kind of have an easy answer, which is I don't short any of the companies I write about. I don't buy puts on any of the companies I write about. And I only make money from paid subscriptions to the newsletter, the Bear Cave and Idea Brunch. And I do some investing on the long side and small cap stuff, although I try not to trade too actively because I just wouldn't ever want there to be a conflict or the perception of a conflict between, my newsletters and my personal trading. In terms of like actual short selling, I probably have some like atypical views relative to like a lot of different funds where I at least for me finding like good short ideas isn't too hard. I think having a portfolio of 10 or 20 is very tough. So at least to me, short selling is best if you've just like got a small handful of positions. And I personally really like if I were to short and or run like a short bias fund or be a dedicated short seller, I'd really like more off the beaten path type stuff. I think when you have these like battleground names like Carvana or Tesla or whatever, it's like maybe it's a good short, maybe it's a good long, but just the fact that it is like an extreme battleground stock just to me signals it can go up 10x, it can go down, like it's just going to be all over the place, and navigating that timing becomes much, much more difficult. Versus if it's like there's tons of these sleepy $1 to $10 billion names that I think are much more like predictable. Like one thing I always ask myself when I'm looking at a company is like, is this something that can rip my face off? Is this something that could 10x in the next 5 months or 5 years? And for like, if you say like, oh, a smaller cap with like a pump and dump CEO, yeah, that's exactly the type of thing that like could. So you might want to avoid writing about that until you see like Mark Cahoda says the jaguar shot out of the tree till you see it starting to crack. I like an example of a company that couldn't rip your face off is like Medical Properties Trust. Like at least a year ago when I wrote on them, they were like a $15 billion hospital REIT with 1% short interest. It's like, how is that like that's like never moved more than like 15% in a month? How is that going to rip your face off? The answer is it probably won't. And that's the type of stuff, if I was a dedicated short seller at a fund, is like finding these sleepy names that no one's ever looked at. And you look at 100 or 200 of them, and a few are going to be great shorts, kind of like IBMs or GEs or whatever. When you look at the smaller cap world, a lot of it becomes a lot more obvious. So that's at least my kind of high level thinking is you find like these sleepy names that don't have a lot of short interest that no one's ever looked deeply at, and you do some work. And I like to bet against people that are, in my view, unethical or self-dealing, or it's like clear that even if they succeed, they don't really care about generating shareholder value. They want to do stuff for themselves. So that's my thinking there. So, Bondoc, that's a perfectly fair question. My answer is like, I'm not really a crypto expert. I'm a big fan of this YouTuber CoffeeZilla, who kind of breaks apart these narratives of all these various coins. And based on his YouTube videos alone, it does seem like there's a lot of nonsense in these narratives where, you say you're doing one thing and you're launching a coin for this purpose, but then it's like you actually dig into it and it's just like lifelong charlatans involved. So yeah, it definitely does seem like a lot of the narratives pushed aren't real, aren't authentic. And I think, at least for me, the way I try to look at it is you follow the person, because the most egregious conduct, like the people involved, will always have had some stuff in the past. I think one of the early companies I wrote about in the Bear Cave was a company called Triteris that was trying to do like blockchain based payments for like international like shipping and stuff. And it just like it turned out like it's collapsed 95% plus since I wrote that on them in the SPAC merger, and I think they were delisted. And it's like, just some basic research is like the CEO previously ran something accused of being a Ponzi scheme. The CEO had like a $3 million federal tax lien for back taxes. It's like this type of person probably didn't find the breakthrough for like crypto international payments. So, that type of discretion is kind of needed to navigate the space.
Final question for me, Edwin, and then we'll wrap up. Why do you hate theme parks? I don't know what the story is with Six Flags, but I saw it as an article. I'm just curious, why is it from as somebody who's bearish and maybe is concerned with some of these kind of story stocks, why Six Flags? Why is that a target for you?
So Six Flags, it's not necessarily a fraud play or like, that the business isn't substantive or something like that. It's they've got a new CEO who just seems a little out of touch with the core user base. And sometimes if you combine a weak CEO with a struggling business, it can be a recipe for disaster. Just look at like Ron Johnson with JC Penney. And Salim Basul, the new CEO of Six Flags, kind of seems like that, where they're making all these Six Flag passes more expensive. Customers are pissed. He's pivoted on his strategy like half a dozen times. And I just think this is a business that has gone bankrupt before. And now that you've antagonized your core user base and you got a lot of other headwinds, it's a business that might go bankrupt again. And I think, if you pay a lot of attention to customer reviews and Reddit threads and YouTube videos and really try to get your pulse on the customer base, you'll see there's like huge issues. And I don't think Wall Street's good at that. Wall Street's good at interpreting numbers. So my kind of gut feeling here is over the next 12 months, you're going to see a lot of this anger and like pissed offness with the customer base be reflected in the numbers that Wall Street doesn't fully appreciate. So that's kind of my high level view on Six Flags. Now, not the worst company in the world, and hey, there's a chance it turns around, but I don't think the market's appreciating the problems there.
I think that's a good place to end the space. Everybody here, don't go to Six Flags if you want to have fun. Instead of read due diligence documents and the SEC website, do what Edwin does here. Edwin, really appreciate your knowledge. Everybody check out Edwin Dorsey's researches, Bear Cave newsletters. Follow him on Twitter. So with that said, everybody here, for the new year, mute or block haters. That's going to be my New Year's resolution, rather than retweeting with a comment all the ridiculous things that people say to somebody who's in the arena who's been going through a hard time this year. I personally think there's a special place in hell for people that kick others when they're down. But thankfully, we're still kicking ourselves. So thank you, Edwin. Thank everybody for joining, and enjoy the rest of your year. Thank you, everybody.